I'm about to show you a scalping strategy so simple that most traders completely ignore it. It uses one single line, not 10 indicators, not 5 confirmations, not some secret algorithm, one line. And if you understand how to trade the break and retest of this level with proper volume confirmation, this can become a repeatable setup you use every single day. And this is called the one line pre-market liquidity strategy. And once you see it, you won't unsee it. But real quick, as always, if you guys do find value in today's video, make sure to smash that like button as well as hitting that subscribe button. It would mean the absolute world to me. And if you haven't, make sure to join my free trading Discord. That link will be down in the description, but let's go ahead. Let's hop into it. So if you guys are not familiar with who I am, I have been trading for 8 years now. I've tested hundreds of strategies, and most strategies are either too complicated or too inconsistent. And the truth, the best scalping setups usually come from liquidity, trap traders, emotional reactions, and volume imbalances. And today's strategy is built on exactly that. So let's go ahead and let's talk about something that most retail traders underestimate. And that is going to be pre-market highs and pre-market lows. Now, my pre-market highs and pre-market lows are going to be within this shaded area right here. And the white line is when the markets are open. Now, before the regular session opens at 9:30 a.m. EST, institutions are already positioning within the market. Liquidity is building, stops are forming, and biases are developing. And what does retail do? They completely ignore it. But here's the reality. Pre-market highs and lows act as liquidity magnets. Above pre-market highs are going to be buy stops. Below pre-market lows are going to be sell stops. That's fuel to the market, and markets move towards fuel. So instead of drawing 20 different lines, we draw just one line at either pre-market high or pre-market low. Now here's where most traders mess up. They think the setup is just break the level. That means enter. That's completely wrong. We are not trading the breakout. We are trading the break and retest with confirmation. That is a very big difference. And here's the sequence. I'm going to show you guys some examples here in a little bit, but price approaches our pre-market high or pre-market low. We can actually look at today's example. Here is our pre-market low. So today we approach this pre-market low. Price breaks through the level. So it pushes through the level. It then pulls back and retests it as it did right here. And that retest is everything. Why? Because that's where you find out if the breakout was real or just a liquidity grab. Because if price can reject off of it, you can look for confirmation to take the trade in the original direction. So as we see, we break below pre-market lows. It comes back. It rejects it right here. This could have been your entry to go short to capture that move down. Ideally, we would look for a further continuation, but based off of this move, you're more than likely trimming and putting your stop loss at break even. And as we see, you would have stopped out at break even. And again, I'll show you guys some more examples here in a little bit, but this is essentially what we are looking for. Up here was a liquidity grab. This was our pre-market high. Price tried to break above it. What happened? It failed to hold above. So because it failed to hold above, anyone who tried to buy that breakout, they got faked out. So when price broke back down below, they stopped out. Anyone who had stops above pre-market high, they also stopped out. And what do we notice? Price ended up dropping to the downside. So now let's break down what's really happening psychologically. This scenario, pre-market high. Retail traders see price breaking out. They FOMO into the longs. Anyone who is short, they get stopped out. The volume spikes. And what happens? Price ends up completely reversing. But here's where it would be different. Instead of buying the actual breakout here, we want to see price actually break with confirmation. If price is able to break above this pre-market high, that means institutions accepted price at a higher level. That's strength and that's real confirmation. But if price breaks, pulls back, and sellers slam it back down below with heavy volume as we saw right here, that is a liquidity sweep. That's when you would be looking for a short entry. This is not random price action. This is order flow and positioning. And this is where the strategy becomes powerful. The volume is your filter. On the break, you want to see expansion. Not weak drifting price, you want conviction. On the retest, volume should not decrease during the pullback to your level. So when price is either breaking above that pre-market high, pulling back and retesting, it should not be weak at the retest. You should see volume come in because that's telling you that buyers are supporting that pre-market high. Or if we break below pre-market low and price comes back up and it retests it, well, we want to start seeing some selling volume to actually confirm that that is now becoming resistance. So the rhythm looks like this. We want to break the level with volume. We want to pull back to it with a little less volume. But then when we actually hit it, we want to look for higher volume to let us know that that either pre-market high is now becoming support or pre-market low is now becoming resistance. If volume increases aggressively against your direction on the retest, typically you want to avoid that trade and you want to stay out. There's no emotions, it's all based on data. So going ahead and looking at this example over here, this is our overnight high. Therefore, we are looking for price to break above it, come back down and retest it, as we can see right here. And here's how you are going to execute this trade cleanly. First, we want to look for price to actually break above that level with strength, as we can see right here. We then want to see price come back down and retest this level. So I'm usually looking for retests either on the 5-minute time frame or the 2-minute time frame. So we will scale it down to a 2-minute time frame to see if that gave confirmation. Our stop is going to be if price takes out the candle that confirmed the long entry off of that pre-market high. So pretty much if we were to lose this level, we would stop out. And bare minimum, I'm looking for at least a 1-hour trade. Ideally, the higher the trade, the better. A lot of people preach a 2-hour trade, but for me personally, I'm looking for at least a 1-hour. Ideally get it up to, 2, 3, 4-hour trades. And we can also use any logical area as a potential price target. So we come down, we bounce off of this pre-market high, which is now becoming support. Whereas the next logical area for price to go is going to be that intraday high right here. So let's scale it down to a 2-minute time frame. You can see that this is the candle that came down and bounced off of this area with a lot of volume. So it did hold this area. Therefore, to me, I would actually be looking to enter based off of this red candle right here. Now, again, a lot of people would probably argue against that. Oh my God, it's so bearish. It has a lot of volume. Guys, you need to understand, where are we trading, right? I can guarantee you if you were watching this, as price came down and started hitting that pre-market high, I can guarantee you started to see some absorption at this area at this lower wick. So again, when we see red candles and red volume, it doesn't necessarily mean bearish. And when we see green candles with green volume, it doesn't necessarily mean bullish, right? You have to understand, where are we trading? So if the market is going to bounce anywhere based off of this strategy, it is right here. So we come down, lots of volume, we wick off of the area. Therefore, to me, this would be the long entry. Now, if you did wait for the 5-minute candle, the risk to reward at that point didn't make quite sense. If you waited for a slight pullback, then yes, it would have made sense. So on this trade, you were risking about 5.5 points. Your price target was around a 3-hour trade, so about 17 points. Again, ideally, I'm looking for at least a 1 to 1.5 hour trade before I start trimming. Ideally, the higher, the better. Now, as we can see, price makes a move right back up into that high a day, which would have been a 3-hour trade somewhere around right there, slightly above high of day. So that's one really good example. Here's another really good example, but to the downside. So as we can see, we have this pre-market low right here. Price breaks below it, comes back up, retest it right here. Now, again, we can scale it down to a 2-minute time frame to see how price reacted. We can see that we are wicking off of this level as well. So the overall risk to reward was very tight on this trade. Let's just say that you entered at the close of this 2-minute candle right here. This is your short entry. Your stop loss is right above if price fails to hold below that pre-market low. Honestly, I already forgot what price did, but let's just go ahead and target new low a day. That's going to be about like a 7.5 hour trade. So if you ended up entering here, you're risking about like 2.5 points, give or take, targeting about 11 points. Like I said, I already forgot what happened. We went into a new low a day and then we went much lower than that. So again, you can see how this strategy plays out. It's very basic. It shows itself quite often within the market. You just want to look for that simple break and retest of that pre-market high or pre-market low. Look for a good risk to reward and look for confirmation, either go long or short. I do want to say this strategy does not work in extremely low volume days. So typically days where the market either closes early or the overall equities market is closed. Those are going to be low volume days. That's when you typically don't want to trade this strategy. If the market's choppy or it's in a really tight range, typically we'll see that days before big news events like, FOMC or CPI, GDP, stuff like that. Major news seconds before the break. So if we were to go break and retest the level, but let's say there's 9:45 news coming out such as PMI or 10 a.m. news such as inflation. Typically, you want to avoid entering just because news could completely invalidate these setups. Another time you would want to avoid taking this trade is if there is a fake break during the first 1 to 2 minutes of the open. So typically the first, I'd say honestly, like 5 minutes is very volatile in the market open. So typically if we were to break and retest this level very quickly in the open,